Dividends are the frosting on top of the investing cake. This is the first of 3 videos coming in the next weeks where I introduce you to 3 strong companies, all of them having more than healthy and consistent dividend distributions, and all of them are surprisingly cheap at the moment, even in the current markets. Investments in dividend-paying companies can provide you with a lot of cash over time, but not every dividend-paying company is a good investment. Although there are still some gems out there that are worthwhile to look at, I say still because in the current market situation, a lot of stocks just have insanely high price levels. Also, it is important to check if the dividend distributions are enduring and sustainable. Is the company really generating the money for the dividend payment, or is it distributing the cash from its reserves? The latter would be a huge red flag for me. I found 3 companies that match these criteria. They all have a pretty strong position in their respective markets. They all own healthy balance sheets with a good asset and debt position, and their shares actually do not seem to be too expensive. If you find this video helpful, make sure to like and subscribe or share with your friends. Before we start with the companies, I'd like to encourage you to read the disclaimer. I'm not owning any of the mentioned shares as of beginning of January 2022 when I'm making these videos, but I found them really interesting, so this can change anytime. The first company is the second biggest pharmacy chain in the US and one of the biggest pharmacy chains in the world, with more than 13,000 stores in 9 countries. Walgreens is headquartered in Deerfield, Illinois, just a few miles north of Chicago, and operates its pharmacies under the brand names Walgreens and Duane Reade. In fiscal year 2021, Walgreens generated about $132 billion in revenues with its 315,000 employees. By end of 2014, Walgreens completed the acquisition of the company Alliance Boots and transformed from a mere US pharmacy chain into an internationally operating pharmacy and health company. In a nutshell, this is what Walgreens is doing. Let's look at how much this business is generating for its owners, the shareholders. Walgreens paid $1.88 per share in fiscal 2021 and $1.84 in fiscal 2020. This is a dividend return rate of 3.5% at the current share price of $54. In total, Walgreens distributed about $1.6 billion dividends in 2021. Typically, the dividends are paid in 4 installments in March, June, September and December. Payment is usually around the 12th of the month. This looks pretty good, but how sustainable are the dividend payments? Walgreens has an incredibly long dividend distribution history. They pay quarterly dividends already since 1933, according to their annual report. This is a consistent run of 89 years or 356 quarters. Since 46 years, they raised the dividend payment every year. With this track record, they belong to the club of the dividend aristocrats. In the past 10 years, they distributed $15 per share in dividends cumulated. So, if you invested 10 years ago in Walgreens stock, nearly half of your invested money would already be returned just by the dividends. So, the dividend history is extremely stable, but can we expect this to continue? Are the dividend payments also sustainably generated, or are they taken from Walgreens substance? To better understand this, we have to analyze the financial strength of the company. First, we look at how much free cash they generate for their owners. If you don't know yet what free cash flow is and why value investors usually ignore earnings and look at free cash flow instead, you can watch my 2-video mini-series on this. I'm setting a link in the left upper corner. In the past 10 years, Walgreens consistently generated high free cash flows. Cumulated, they generated about $45 billion in this time period. To put this figure into perspective, the whole company Walgreens currently costs only $45 billion at the stock exchanges. As Walgreens distributes $1.6 billion dividends in total, they have a 39% payout ratio of the 2021 free cash flow of about $4.1 billion. So the dividend payment is very well covered by the cash the company generates. The second thing we need to do to understand Walgreens' financial strengths is to analyze the asset and debt situation. Balance sheets of big companies like Walgreens are usually a bit more complex, and we could probably make an hour-long video just about the assets and debts. For the sake of keeping this video rather compact, here's a very short summary. The balance sheet calculates the shareholders' equity with $23.4 billion. I usually exclude the goodwill and the intangible assets of that. To be on the safe side, we also deduct another $1.5 billion from the non-current assets and receive $0 as shareholders' equity. This is potentially understated, as especially the non-considered intangibles leave a lot of room for further value. Let's keep this in the back of our head for the calculation of the company value later. The goodwill to asset ratio of 15% is much lower than, for example, the 35% of the biggest competitor, CVS Health. To me, this is an indicator that there is still room for further investments and acquisitions. The long-term debts have been reduced by 32% from $12.2 billion to $7.7 billion since last year. In times of rising inflation and interest rates, high long-term debt could become an Achilles heel for any company. Therefore, it is good to see that Walgreens' long-term debt are on a healthy level. If push comes to shove, they could be paid by less than 2 years of Walgreens' free cash flow. So, in a nutshell, I didn't see any red flags in the balance sheet. By my calculation, it looks quite healthy. Apart from the dividend payment, is the company worth its price? Let's crunch the figures and try to estimate Walgreens' value. Walgreens' free cash increased by roughly 15% annually in the past 22 years. This already includes the little stagnation that we saw in the past 3 years. Let's take the 15% growth rate and the 2021 free cash flow figure of $4.1 billion and put both into my company evaluation spreadsheet that you can also, as usual, download from my webpage for free. The sheet discounts the free cash flow and we put in $0 as shareholders' equity. The total present value of Walgreens is about $61.8 billion by my estimation. When we put in the 865 million stocks outstanding, we receive a value per stock of $71. The current price at the stock exchanges is about $54. This means that the stock price alone already contains a margin of safety of about 24%. And our discount rate already contains a desired return of 8% per year. Considering that we were very careful with the calculation of the shareholders' equity, there is probably a further margin of safety included in the assets of the company. The balance sheet itself calculates the shareholders' equity with $23.4 billion, which would be an additional shareholders' equity of about $27 on top of the $71 per stock. The truth is probably somewhere in between. In my opinion, you receive a lot of value for the price you pay for a stock at the moment, including a steady and sustainable flow of dividends. Walgreens is maybe not growing as fast like, for example, software or internet companies, but by my personal analysis, their business is rock solid and they still put a lot of efforts into finding opportunities to grow and improve their business. I think there is still a lot of potential, national as well as international. Walgreens itself currently adjusts its strategy and works on the next wave of growth. They intend to become a leading provider of local clinical care services, improve health outcomes and lower costs, and just recently invested in the company VillageMD to open approximately 1,000 physician-led primary care clinics by the year 2027. The video with the second strong dividend company you can watch if you click right here or in the box below the video. I'll set the links as soon as the video is released.